Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. I'm excited to be here today with Andrew Femrite, good buddy of mine and fellow real estate investor. And the reason I brought him on the show today is that a little bit different from some of the things that we've talked about in the past. We've talked a lot about house hacking and people that have purchased a new place and rented out their old place. Andrew went straight into the investment side of things. So I want to talk a little bit about his experience. And this really happened over the last year, but was his first experience with investment real estate. So welcome. Thanks for being here.
Glad to be here.
Appreciate it. And start off just with a little bit of background, maybe a little bit of your background, and maybe even some of your investment background and what kind of drew you to get into real estate now.
So sure. My wife and I married 29 years, almost in a row. And we are traditional market investors, I guess, equities and such. My career spans 25 years in electrical engineering, sales, technical sales. So completely out of the real estate realm. No experience until I ran into Nick, and we started talking a little over a year ago. So I guess where it started, where I really got engaged and called Nick and said, okay, we're ready to go, was after a friend of mine for many years had been talking about his commercial and residential investments and trying to talk me into things, but I was focused on my career. And then, my son got a head start on us about 2 years ago. He's up in Boston. He started buying some multi-unit properties. And so he kind of was chewing on us in the other ear. And we've been empty nesters for a couple of years. So at this point, I'm in the sunset of my career. I decided I finally have the bandwidth to really dip both feet in. So we talked to Nick about what our serious first steps were, and we hit the market hard during a really aggressive time.
Yeah, we were definitely we were in the peak of the 2022 market, right? And so and I want to talk about that a little bit, because I think there's people that have that bought in that market, anywhere from really 2020 to 2022. Us here in Colorado, mostly 2021 and 2022, but even people that kind of have buyer's remorse from buying during that time. But I think there's a flip side to that too. And so I'm interested to hear your opinion. I think we'll come back to that. I kind of want to hear what your thoughts are on buying at that time in the market. But I think it goes, I don't think we could have this conversation. I don't even know if we'd be here if maybe your son wasn't also a catalyst to this as well. And your son's story is really cool. He has done the ultimate house hack. That is using low down payment leverage to purchase multi-units and living in one of them. So his first one was a quad, right? He bought a quadruplex for his very first property. Did he use an FHA loan on that?
He absolutely did.
Yeah. So you can buy a quadruplex with 3.5% down. So even if it's $1 million property, you're looking at $35,000 down payment to acquire $1 million worth of assets and then rent the other 3 that pretty much covers your whole mortgage payment, if not covers the whole mortgage payment, and then you live for free, and then eventually you move out and do it again. And so anyway, that's a pretty cool thing. So when did he do that, by the way?
I think he started probably a year before we did, roughly speaking.
Okay.
And he's a completely different animal. The kid's half crazy. He's got so much energy. He doesn't know what to do with it. That's not my situation.
Sure.
So I'm kind of I want to focus on one thing and be successful at it, which is why I waited so long. I wish I hadn't, by the way. I wish I knew, 20 years ago what I know now, having been a traditional investor, made good money in my career, made reasonably good decisions along the way. So we had some money set aside to to start getting involved in this. But we're sure glad we did, and thanks to Nick and his mentorship, we were successful in a very short span of time.
So what was the process like? I mean, obviously, once you have that mindset of like, okay, I think we should buy some real estate. Like, what was your first step? What was like?
I remember kind of retracing our first steps and thinking, you asked us several times what our goal was, and we kind of blanked. Like, I don't know. I guess we should come up with a goal.
Right.
So I had to think through that for a while as we started looking at properties. What kind of properties? We should figure out what our target market is, and agreed with a basic formula that Nick recommended. Kind of 3.2, 3.3s, 3-bedroom, 3-bath, and roughly in that realm. But in that time, beggars could not be choosers. So we hit the ground running, and the learning curve was steep for us. Just figuring out how to, compete and make aggressive offers in this environment that we had. So I remember making 14 offers to get four properties.
Yeah, that sounds about right.
So we started in mid-January. It was our first conversation or email.
Yeah.
And then by mid-May, we had closed on our fourth property.
Right. So basically a property a month, essentially. I know we had a couple under contract simultaneously, I think, at one point. But I mean, the idea was that we had a financial goal. We knew what we were starting with, and so we knew what our end game was. And then you just go out and you execute. And I think in a normal market, it probably wouldn't even have taken 4 months. And it would certainly have taken 14 offers. But we were, again, we were in a market where, did we pay even close to list price on anything that
No.
I mean, everything was significantly over list price, waived inspections. It was one of those markets. And I want to get into that too about, is there regret on buying in a market like that? Because some of the things that we see, especially with homeowners themselves, looking back and going, oh my God, I overpaid for this property, or it's not worth what it was when I bought it, or I waived the inspection. And now I've got all these, these issues with the property. And so, we were in a very, very difficult market, very low inventory, beggars couldn't be choosers type thing. But we put ourselves, I think, in a very good position from the start financially. And then, like you said, the learning curve was steep, but you guys learned very quickly how aggressive you needed to be to make something happen, and how quickly you needed to act when something came up.
Yep.
And so anyway, I think like that I think that paints a decent picture of like what the acquisition process kind of looked like. Now that those properties have been acquired, so now we're about a year and a half into the ownership of those properties. Tell us something basically that, what's something that you know now that you didn't know then?
So, like you, I do want to go back and retrace a few of those specific steps. So I think it would help a lot of your followers. But
Sure.
The short answer to that is there's one thing that I've come across since the tax season, going through the first tax season, and really trying to get my head around all of that, which I'm probably still only about 80, 90% there. But the real estate professional definition, if I had thought about that early on, I would have kept a better log of what I'm doing, with my rental properties. I'm not in the real estate business professionally. So tax wise, if you want to count your income loss, your depreciation or losses against your properties, against your active income, you must be a real estate professional, which means you have to prove that you spent at least 750 hours on real estate through a year. And I think not being in the business as a non-real estate professional, it's kind of fraught with peril.
Yeah.
From an IRS standpoint. So I wouldn't necessarily try that this year, but next year, hopefully when I am fully retired at some point next year, I'll be able to do that.
Yeah, there's a place there at that point where you can potentially go, 750 hours I'm around that, and I can legitimately go to the IRS and say, that's what I do now with my time, is I manage my properties,
right.
and you can move to that route. Yeah, I mean, ultimately that part of the IRS tax code, the the real estate professional part of the tax code is so powerful, like beyond anything, like so much far above and beyond just normal power of real estate, that if you can get to that point, that's a really, really crazy thing, from an income standpoint. But even so, did you, on your 4 properties, well, first of all, let's do this. Are each of your properties, do each of them cash flow? Do they have positive cash flow?
Yes, they do.
Okay. Did you, with that positive cash flow, did you owe any taxes on your real estate from last year?
No.
Right.
No, we definitely showed a loss as intended,
right,
for each and every one. That might get more difficult as time goes on.
Yep.
I do want to, I have just random thoughts. One of the key aspects that really got us engaged as well. We went to one of your seminars, in which kind of everything came together. I'm like, okay, I hear everything that my son's been saying, that my friend Scott's been saying, and that Nick's been telling me recently. They all are saying the same thing. And then one thing stood out that, rent, generally speaking, doesn't go down even in a bad market. And I know there's exceptions to everything, but generally speaking, if that's true, that makes this a reasonably safe risk. The oxymoron, right? But compared with investing in a stock market and a risky stock, right? So I think that the premise is, if you find good tenants, you maintain good relationships with them, which is not always that easy, as we've discovered.
Right.
So probably leads me to the other. What I wish I knew a year ago was, trying to find tenants. Tenant placement in an off season that was really uphill.
Yeah,
that was tough.
Yeah.
So February, March were very challenging for us.
Yep.
We had to stay really patient until we found the right tenant, at the risk of maybe even having some vacancy, which we ended up not having, maybe a day or two.
Yeah.
So that was nothing. So it turned out.
Yeah. In the grand scheme of things, I think the hardship, quote unquote hardship, that you've found with tenant placement was not much compared to what it can be in a down market or in a down season. But ultimately what it comes down to is I think you guys also did a very good job at staying in your lane when it came to what you're charging for rent. And I think that's the biggest mistake that people get, is they put a property up and they go, well, I can maybe just get like $100 more. The thing is, rent is really crazy. It's not like in a crazy housing market. Like when we purchased these homes, when people were pricing properties, they could have basically priced them anywhere and they probably would have sold. The rent market's not like that. If you miss your rent by $100, you will hear crickets. And that's what's really crazy about it. So we really have to fine tune. We really have to know where our rent rate needs to be, because and if you get greedy, you're going to lose, because we've talked about this on the podcast before, but over $100 a month in let's say a $3,000 per month rental, like in 30 days, if you have 1 month of vacancy, you've lost your entire increase.
A lot more costly.
It's way more costly, right?
Trash your ROI, everything.
It's terrible. So you're much better off. I mean, in fact, let me restate that, because that was incorrect. If you have a $3,000 per month rental that you're overpriced by $100, it takes you 12 days to lose the entire lease amount of increase that you think you're getting by charging an extra $100. 12 days of vacancy. And so this is where people run into the trap of, or even like when they go to increase their rents, they go to increase it and they're trying to increase it more than the market calls for. And they'll let a tenant move out over $25 or $50 going, well, I know I can get that. Yeah. And you're going to lose that literally in a week of vacancy.
That's unnecessary risk. So I think that's the second major learning that we had more recently, having gone through a full year with all 4. We value our tenants. The next biggest goal is stability and tenant retention. And so we didn't go crazy on the increases. We kind of met people in the middle. We could have gotten more in a couple of cases, I'm pretty sure, but why bother when we have, it's a bird in the hand. Yep. Why not just keep it going, a little bit increase? Let's come back and talk about the major property tax assessments that we're now going to see kick us next year.
Yeah.
But aside from that, no, I don't regret that process and decision that we made not to crank rents too high. But having been very aggressive on offers way over list, not detrimentally. We realized at the time there were people who just were trying to find places to live and were willing to do anything. And we didn't go that far. We let them win.
Yeah.
But we dissected our losses and understood whether we lost because of that or whether we just didn't we didn't have we didn't have our offer configured right. So we really refined our formula quickly.
And I think that's why, again, there were people that did 14 offers and didn't get a single house, right? And we did 4 with 14 offers, and out of those 14, at least half of those were strategically where we were like, we could have, there were a handful of times where I called you and said, it's yours if you want it, but we got to do this. And we said, the numbers don't shake out that way, right? The deal just doesn't pencil if we go to that. And I think it's important to understand that. And I do still think, I do think there's one property that we acquired that I still think we got a deal on, regardless of the market.
The first one.
I'm talking about the single on Shenandoah. Was that the first one?
Yeah.
Firestone.
Yeah, we did.
So that property, the strategy that we had on that one was a little interesting because the property was so underpriced that we went in just super aggressive, and gave a quick turnaround and said, "Hey, answer us now, and we'll give you." What was it, $70,000 over list price or something like that?
Pretty close, yeah.
But we comped the property out at like $100,000 over list price, and so we still think we bought the property at a $30,000 discount. Mm-hmm. And honestly, that property has had the best growth in the last year and the best rent growth in the last year as well. And so, there in every market there are opportunities to be had. They're further, they're fewer and farther in between. In markets like that. But I think that again, I guess my question would be, let's say we did overpay for those properties. And let's say, let's say all 4 of them were down, let's say we're down 6% on them, which would be okay. That would sound about right. So on a $500,000 property, it's now worth $470,000. Do you have regret buying at the time?
Actually, yeah, the punchline on that, to your question is no, I have no regrets. So this was not never was, never will be a get rich quick. It's a long term. To answer the goal question, we decided this is about growing our net worth. This is growing wealth and not even cash flow. I'll come back to the cash flow point too. But the properties are all 4 somewhat underwater right now, and that's expected in the market we're in with the interest rates and where they've gone.
Sure.
But it's cyclical. We have no concerns. Colorado is a beautiful place to be, and the properties we've invested in, I have confidence in. I'd say 3 out of 4 I feel pretty good about. But that first one was definitely a little bit outside our formula. But again, we felt like, okay, we just got to get started somewhere. We've got to be flexible. And it was a little larger than we wanted, a little bit further away. I wanted all 4 to be within arm's reach because I'm providing my own management. I'm a homeowner for 25 plus years. I know how to fix a number of things myself. I can do this until I can't, until I'm overwhelmed by that. But we also have warranties on the properties for the big, plumbing and electrical issues and so forth.
Right. And I think that excuse me, the reality is, and one of the points that I try to get at with people. So I bought a house in the peak of the market last year too. I bought in April of last year. Right. And so, I'm 100% underwater on that property. But the reality is every stock you and I have ever owned has been underwater at some point as well.
Absolutely.
And every stock that we now own, that we've held for any decent period of time is probably no longer underwater.
You don't lose a thing unless you sell.
That's right. And so it's really just like an immaterial, it's just on paper, right? And the reality is you could buy one of those properties right now, okay, maybe at a $30,000 discount, which from a down payment standpoint is only $6,000. Mm-hmm. So it saves you $6,000 out of pocket, okay, but your mortgage is going to be about $800 higher. Mm-hmm. If all of your mortgages, okay, that you had in these 4 properties, they were all $800 higher, what would your cash flow look like?
We would be way underwater.
You'd be negative on every single property,
absolutely.
Right? And so the reality is here's your $6,000 back, okay, but you're going to lose $400 a month instead of gain $400 a month.
Yeah.
So the reality is it's the power of leverage that makes this work, it doesn't matter what the price is. For those of you that like to really look into a ton of real estate stuff, look up Pace Morby. Pace Morby does sub 2 properties. So basically what we call, they're called sub 2, but it means subject to. It basically means he takes over the other people's loans, and he will pay or overpay for any property as long as it cash flows, because the money is not his. He's using their loan. Okay. So if he can go acquire a loan at 2.75% right now, because he's going to use that other person's loan, where if he went out and bought it himself right now, it'd be at 7.5%. The power, what he's buying is the note. He's buying the loan at 2.75%. He's not buying the property. He's buying the loan. The property gets titled into his name. And this is for a whole different podcast, is to talk about sub 2. But the idea is that the power of real estate is through leverage. And that's it. So when you look at, would you rather overpay for a property, overpay 30 grand for a property and make $400 a month cash flow, or get get a $30,000 discount, but have a negative $400 cash flow? I mean, I'll take the overpayment all day, every day.
Absolutely. We knew we were in a race against the clock with interest rates going up, and that was the main driver. Right. And the rest is history, right?
And I think your last 2 properties, if I remember correctly, were slightly higher. The rates were slightly higher.
A little north of 4.
Right. They were higher than the first 2. I mean, your first 2 were south of 4, right?
Yeah, just under 4, yeah.
And what the funny thing is in the grand scheme of things, we looked at that, and I remember having the conversations with you when they were climbing up above 4, and we were like, oh. And now an investor rate's 8.5, 7.5 points.
No.
And so it's not even close. I mean, your mortgage payments, the interest on them would be double. Yeah. So most of your mortgage payments probably have somewhere around, $1,500 a month in interest on them. Mm-hmm. Your mortgage payment would be $1,500 higher in our current rate market. And so it is really important to understand that regardless of, and that was the point that I wanted to make, was regardless of what the market looked like last year, the value is in the acquisition of low interest debt. It's not in the acquisition of the property. It's in the acquisition of low interest debt. And that's why I wanted to ask, are there regrets about the acquisition of property at the time? Because the answer should be no. And it is.
Absolutely no.
And so I think that's, I much rather would have bought, in hindsight, if I'd known rates are going to double, I would have bought more property at a higher value at a better, rate last year.
Appreciation will come eventually. Sure. I think 5 years from now, when we look back, we're going to be very happy with, where we're at in the amortization scheme, and the property values, I'm sure, will be above water by then.
Sure.
So that's not even a concern. No regrets at all.
So tell me about, just in general, the experience now, getting away from like the acquisition of the real estate and the monetary side. What has been your biggest challenge, like as a self-managing landlord?
I guess the first thing that comes to mind is just that February-March cycle of tenant placement for one of our properties, and just challenge of finding good tenants, while also trying to get the property ready for the next tenant. There were a number of little things that needed to be fixed. And every time I found one, 3 more would pop up. And that just seemed to go on forever until it didn't. And so I think I traveled to the property something like 25 times in the span of a month and a half. It was pretty crazy.
To a single property?
Single property, showings and fixing things and a variety of issues.
Sure.
Just small things, really.
So with that, what lesson was learned, or have you done anything to try to remedy that moving forward?
No, short answer.
Okay.
I mean, we can plan for some things that will need to be maintained or repaired between tenants, or, in those inflection points. But some of that's you just have to be flexible and ready to blitz.
So one of the, and I can't remember if it was a conversation with you or someone else, but one of the conversations I have with this is so one of your big issues was that February, March is a tough time to rent. Okay, well, if you're consistently doing 1-year leases, you're going to end up in February, March. So was it you that I talked to about do a 14-month lease?
Absolutely, yeah.
So one of the things to overcome, so for every problem, I think there's a solution. And so I agree. There are very difficult times to rent properties. February, March is one of those times. September is another one of those times. And so anytime you have a lease that is expiring in those times, when we renew that lease, we do our best to get it into a better time. So like May or June. And so we talked about, hey, ask them to do a 14-month lease.
Yeah.
Did you end up doing that with anybody?
Absolutely. Great advice. They were very amenable to that. One time, made it clear we wouldn't do this every time, and that was very simple.
Perfect. Yeah. So now moving forward, there'll be 1-year leases, and they'll always renew in May or June or whatever. And I want everybody to take that into consideration too. So I have a couple of properties where I'm flexible on my leases. So I like if somebody wants to lease for 6 months, fine. If somebody wants to lease for 3 months, fine. But I take into consideration when that's going to end. Okay. And the price of my lease or my maybe willingness to even do that is going to be based upon that. So if I have somebody, I'll give you an example. I had a property last year that I rented in June, great time to rent it. And they said, would you do an 8-month lease? And that would put me in February. And so I said, no. I said, I'll do a 10-month lease if you'd like, because that'll get me to April. But no, I will not do an 8-month lease. They ended up actually doing a 10-month, plus they did 2 or 3 months of month to month. And so now we ended up back in May and June again.
Good money too.
and we were good. Now if somebody comes in and says, like, let's say in June and says, I want to do 3 months, I will do 3 months. But I'll tell you, I know that that's going to put me in September, which is a terrible time to lease. So I'll do 3 months only if the rent is good enough to cover not only my 3 months, okay, but then a jump on those 3 that is going to cover a vacancy in September and probably another month of just the fact that I'm going to have to release it in 3 months again, the amount of work. So if somebody comes in and let's say the property's $3,000 per month, okay, and you want to do a 3-month lease, I'm probably going to charge you $4,000 per month, okay, which is going to give me an extra $3,000 over that period of time to cover me a month. And I'm probably going to keep your security deposit. So it's basically going to be like, hey, I'll charge you $3,000 or I'll charge you $4,000 a month. And I'm going to keep the $3,000 deposit. And I've done deals with people before where I'll say, I'll charge you $4,000 and I'm going to keep your security deposit. However, if I can get it rented, I'll only make you pay for that vacancy, right? So if I can get it re-rented, I'll give you back your security deposit pro rata based on what my vacancy was, right? But I'm always going to make sure that financially I'm made whole to be put in a position like that where A, I may run into a month of vacancy, and B, I have to go through this whole process again of finding a tenant 3 months from now. So anytime you're doing midterm or short-term stuff, like you got to make sure that it really makes sense to you.
I don't think I'm comfortable with that yet, but under those parameters, I probably would be. Definitely pad your risk for sure. It's greater risk for shorter lease periods. The other really important aspect of that that we've learned and stuck to is, I mean, you've got to be 60 plus days out on an agreement with your tenants. Are you staying or are you going?
Yep.
So, we've written that into the lease now, where if we don't have a deal on that 60th day before the lease term ends,
we're going to market it.
By default, we have the right to market it.
Right.
And so that's, I think, a better deal for both tenants and landlords, right? So we both know where we stand way ahead of time.
Yep. Because the people who, the better people to rent to are the ones that are looking 60 days in advance. The ones that are like, I need a place by next week. Those are not good renters. They're ill prepared, obviously. I mean, there's certain circumstances. I get it. People like, and we've done things. I can tell you some of the most lucrative deals are some of those midterm rentals because, I've done them before where we did insurance deals where somebody was out of their house because of fire damage and they needed to put them somewhere for 3 or 4 months. I mean, I would go to an insurance company and they'd give me 1.5 to 2 times rent to rent to their clients for 2 or 3 months.
Wow.
And sometimes it was even beneficial. It would be something that came up in February, and they'd be like, "Can we just do 3 months?" And I'd be like, "Oh, that would be beautiful to do 3 months, and I'll still get a nice premium." And so there are other ways to get there's relo stuff. There's all kinds of stuff where you can get higher rents. And generally speaking, some of these are the quality of property needs to be a little bit higher because, the insurance company is not going to take their people and put them into another rough property. And then relo, companies that are reloing, individuals, they're going to put them in a nice property as well. So anyway, there's opportunity there, but I think that's a good lesson learned, but I don't think you can buy a house determined upon like when it's going to lease. Like I wouldn't be like, well, I'm not going to buy in January because I'm going to have to rent it in February. Right. I'm going to buy it in January because I'm going to get a better deal than buying it in April. And I know I can still rent it in February, and I'm just going to put it on a 14-month lease so I don't ever really have to deal with that again. Well,
so you're very seasoned. You've had many years to kind of see different cycles over different times of the year and what effect that has on your lease renewal. For us, going through it for only one time, the first time, I had our first tenant in Firestone. He was bugging me in December before Christmas for, I think it's end of February renewal. And this is a good problem to have.
Yeah.
I'm glad he's anxious. I hear you. However, I just need to get my head around what's my cash flow going to be next year? So where are the taxes going to be?
Yep.
I just had HOA because of inflation. All 4 HOAs went up dramatically.
Yep.
And so, homeowners insurance also went up. So everything was going up.
Yep.
And so I had to say, just give me another month to kind of get a handle on things, and then I'll give you a reasonable proposal.
And I think it's important to reiterate too, like people think like we're just raising rents and we're just making more money. But the reality is like we're raising rents to cover our hard costs.
Yeah.
And a lot of times like this next year, there's no way my rent increases will cover the increases in hard costs because insurance went nuts last year and this year.
Yep.
Property taxes went absolutely nuts this year.
Mm-hmm.
And everything, like you said, HOA, because insurances are getting more expensive, HOAs are getting more expensive, especially on townhomes and things like that.
Yeah.
So just things in general are just more expensive. Inflation has created everything, this expansion of everything monetarily. So even our rent increases, we're not going to be able to overcome the hard costs. So I fully expect my cash flow to decrease next year.
Yeah.
But it's one of the things that we have to understand that our cash flow is like number 4, number 5 on the list of the reasons that we invest in real estate, right?
Yes.
And so I think it's important to realize that so many people that I talk to are like, cash flow, cash flow, cash flow. Well, again, I've stated it 100 times. Colorado's not the place to do it.
If that's your goal, you might be in the wrong market.
Yeah, just go somewhere else. Go to Detroit. I saw something insane the other day. It was a quadplex that rented for $1,800 a month total, like between all 4 units. But it was on sale. It was for sale for $105,000 and $105,000 for $1,800 a month cash flow. That's insane cash flow.
Yeah. What's the catch?
The catch is 4 units renting for $1,800 is $450 a unit. What type of tenant are you getting for $450 per month in Detroit?
Ooh.
Right. So the property's in Detroit. The rents are $450. That's the trade-off that you get. And what other type of trade-off are you getting? Zero appreciation. There's a reason that property's $105,000. It was $105,000 30 years ago.
Yeah.
And it's still $105,000. So you get great cash flow, which is nice. If you're in a place where you just need cash flow and you don't need to build any more wealth, you're worth $30 million and you just want to create cash flow, sure, go buy a bunch of slumlord type properties and cash flow the heck out of them.
Well, the biggest surprise of this inflation effect on the property taxes is that most of us didn't anticipate, I think. The change in the laws allowed for no capping of property tax increases, and here we are. Some of us have, double, even triple digit increases of assessments. And so I part of the learning curve, had to go through my first assessment, appeal.
Mm-hmm.
And so we've gotten 1 no back already out of the 5 that including our personal property,
sure.
right? Our primary. So I'm not optimistic about the other one.
Yeah, I think we're supposed to hear back by mid-August or something like that on all of them. And then you I don't know if you know this, you do have you have the ability to do a second appeal.
Yeah.
I don't know if it's worth it, but I think we're going to hear a lot of those. I really do. I think while some of them were exorbitant, they were not unreasonable. And it's because we were so far behind the 8 ball before. I mean, we were all pretty happy with our assessments prior, and now that they're actually, right around where our market calls for, people are up in arms because our taxes are going nuts.
Well, I get that it's formulaic, and they're going with, the end of the assessment period is June 30, 22. So that was the absolute peak of the housing market, and then it dropped from there. So hopefully in 2 years we'll get some relief from that, but I guess I'll believe that when I see it. So
yeah, we'll see if actually they pull. I'm never optimistic about taxes going down, whether it's percentage or mill levy or even assessed values. I'm never very optimistic about that. So
I want to go back to the cash flow issue. So short answer, yes, we do have cash flow, but we also have a unique situation that you're aware of. So we as I approach retirement, we look at what are our assets, and the house being one doesn't count, right? You can't retire in a house. And so what do? We're living in it. We love it. We love where we are, but it doesn't do us any good other than the utility of it. So we took out a HELOC, and we used that HELOC as our down payment toward these properties. Well, as it turns out, our cash flow now pays for that 5th mortgage loan.
Sure.
And do we regret that? No, I thought about this a lot. It's actually a pretty cool thing. We basically 100% financed all these.
Yes.
And we paid some out-of-pocket cash because of closing costs and whatnot, but 100% financing, that's maybe better than my son's deal.
That's what I'm saying. Like 100% financing. This is where people really this is where you just have this crazy leverage figure that exponentially increases your return, because technically if you're zero cash in, then any cash flow is infinite, right? So any cash flow is infinite return. Mm-hmm. And so the idea here is that you've used this asset that you have that you're leveraging to create more leverage, and then down the road the idea is to re-leverage all of those. Mm-hmm. and you never paid for any of that property in the first place. So as your tenants pay more and more, and you pay mortgage balance, and the mortgage balance goes down, and then you borrow that money again, it's like you acquired an asset based on the appreciation of another asset. None of this money was out of pocket. And so is it your money? Sure. But I love the word that you use is utility. There is no utility in owning a home outright, for example, right? Like you could retire on the value of that asset maybe, but if you sell it, you now don't have a home.
Yeah.
Right. And so I always use that example of people who are sitting on a home with a tremendous amount of equity. To me, in my eyes, and maybe I'm looking at this the wrong way, but in my eyes, if you're sitting on a property with, let's say $500,000 in equity, I literally think that's the equivalent of sitting on $500,000 in a savings account. And if it's not being put to work, then, and you're earning, 0.1% in interest, and in fact, you would be earning no interest on it. You're literally losing money at that point because you're losing to inflation. And so that's why I push so heavily. I'm like the anti Dave Ramsey, right? About like paying off your debt. And I think Dave Ramsey is for a lot of people. I think it works for a lot of people, but people who are financially conscious and can understand the value of good debt and be able to rein themselves in, right? Like you didn't take out $500,000 line of credit and go on this crazy vacation. Right. You put it to work. You borrowed it at, let's say, 7%. And let it make you 27%. Mm-hmm. That's the difference.
Yeah. So that was really the tipping point where we said, we have this great resource and we're living in it. Love it, but it could be doing so much more for us and, sure. our net worth, basically.
Sure. So I think last thing would be just any final thoughts, anything we didn't talk about, something that you think like, I wish I would have known this, or I'm glad I did this. Something maybe profound to you?
No, nothing big stands out other than the things I've mentioned. The devil's in the details for me. I'm a very left brain kind of person when it comes to these issues. So just the process of learning the contract to close, applying for loans and getting through all that, and then taxes and tenant acquisition, tenant replacement, all these little things along the way. I'm really happy that we've done it. There are no major regrets at all. We'll definitely do things a little bit better every time. Eventually, I might hire a property manager.
Yeah.
I wanted to do it for a year or two myself so that I know what I'm paying for if I ever do want to pay that extra 10%. Yep. There are management companies out there that offer, pieces.
Like a hybrid.
Yeah.
They'll place for you or they'll just manage for you.
Yeah. And I might go that route. That sounds attractive. We'll see what the value of these home warranties turns out to be. I mean, generally speaking, I think insurance is, it's stacked in the insurance company's favor, right?
Sure.
They have actuaries that already figured it out, and they're smarter than me. So we'll see.
And I think home warranties are another form of leverage in the fact that you pay for it this year and you don't use it, and you're like, I didn't use it. But when the furnace goes, it'll use 8 years worth of the cost of a warranty, to get it taken care of. And so it's like, I have a couple properties that I don't have warranties on. And the reason for that is because they're newer properties. So I'm not going to have any big systems that I need to take care of. But I also have a couple properties that I have 20-year-old water heaters in. And I'm like, it's going to go. It's just a matter of,
sooner or later.
It's just a matter of when. So I think the last thing I wanted to put into perspective is and I think I've talked about this before on some other things, but the importance of putting together a good team when doing something like this, right? So it was when Andrew talks about the process of going through from the start, the conversation wasn't Andrew sending me a property and going, hey, we're looking to buy a rental property, and they send me this property and I go, great, let's go put an offer on it. The conversation wasn't that at all. The conversation was, can we sit down and talk about what your financial goals are in order to get you where you want to go? Because maybe real estate isn't even for you. Let's talk about that first. Mm-hmm. And so I want to stress the fact that all the things that Andrew's talking about that he's experienced through year one, with a normal resale real estate agent that just sells homes and doesn't understand what would your experience have been like with somebody that didn't know rental real estate? Oh boy.
So yeah, I knew from 10 years before we started this conversation, having known Nick in a prior life, that you were also kind of a left brain guy, finance guy, if you will, right? Not a real estate, somebody who just can open the door and show us a few rooms. Night and day. You were able to help us craft not only our fine tune our goals, but craft those offers and really understand what we were getting into at every step of the way. Yeah. I could not have done it otherwise. There's no way I would have had the confidence.
Yeah, because I think the other thing is out of those 14 offers that we made, there were for every offer there was probably another 8 properties, right?
Yeah.
So we took 100 properties and narrowed it down to 14, and then got 4 of them accepted. And so the problem is with the general resale agent is, Andrew's going to send a property and say, hey, I want to buy this as a rental. And they're going to go, great, let's write up the contract. Yeah. And having a team of people that go, well, let's run numbers on it. Let's see if this thing even pencils before we even bother. Yeah. I think is key. And what happens is, and Andrew experienced this, but what happens is you start off not really knowing what you're doing. And by the time you're done, you're like an expert, and you can look at a property. You go, all you need to do is look at the price, look at where it is, what you think it's going to rent for, taxes, insurance, and HOA. And you're kind of like, yeah, that one could work. Let's go look at it. But when you first start, you're looking at, oh, that property looks good, but you forgot to look at the HOA. You forgot to look that it's $4,000 or $5,000 a year in taxes. And so those are things that are important. And I think even just the after the fact piece, like, the amount of information we give on, like, here's how you should rent it. Here's what you should, here's some resources that you need. Here's what you need to look for when you're looking for tenants. Like, these are all things that I don't know that you can I don't know that you can put a value on them,
No.
really. I mean, because the value is you probably don't do it without that type of guidance.
Yeah.
And it goes back to a couple of the podcasts that we've talked about before, but it's like anything that's worth doing is worth doing right. So hire a professional to do it. And that's why I brought Clayton Shearer on here, right? And is if you're gonna do a financial plan, talk to somebody who does financial plans, right? If you're gonna get a coach, if you want to learn how to do something properly, get a coach, right? If you're going to get into real estate, talk to somebody that does it for a living and practices it themselves, right?
But knowing those numbers, running those numbers, really appealed to the engineering side of my brain.
Sure.
And it gave us the confidence. Like I said, it goes back to what I said earlier. We didn't do anything stupid. We didn't compete with people who desperately needed a place to live, and they were willing to go so far over list that the numbers broke, right? So we stayed within our boundaries, a little bit uncomfortable in a couple places, and we learned that that's what we had to do to win. Just be a little bit uncomfortable, right? But not be stupid. And so we got through that. But when you said team a few minutes ago, it also reminded me, we need, I can't fix everything. It's not just the home warranty that covers the rest. Yep. You got to have people. You gave me a carpet guy, you gave me a painter, and, a variety of other people that we needed. We targeted turnkey or near turnkey places, but there was always something that needed a little adjustment before that first tenant moved in. Yep. It was a tight window. So that, we didn't have vacancies. So the team is big.
It's huge. Having the right lender that understands having the right lender that understands the real estate investment side of things, the proper, depending on, what you're doing, but, title companies and property management companies and a CPA to make sure your taxes get filed properly. You try to do all these things yourself, and there's going to be things that slip through the cracks, and those things that slip through the cracks are going to be far more expensive than paying the professional to help you get through it in the first place.
And stressful.
and stressful, right? Because there are definitely points, and this will happen anytime you're new at something, but there are definitely points where it was like you could tell Andrew was just putting his trust out there, like, Nick, what do you like? What do I do? What do you think? Yeah. Just put the trust and go, no. This is what we're going to do. Trust me. This is what we have to do to get the property, and it's going to work. And so there is a certain level of trust there when you first start until you really get the knowledge yourself. And so I think that's hugely important, especially when you're dealing with like a huge investment. Because again, it wasn't just your money; it was borrowed money now too. Right?
Yeah, and frankly, I'm a very conservative investor in general. And at this stage of my career, I'm not interested in huge risk.
Right. Yeah, exactly. So, well, cool, man. Hey, thanks so much for being here. I appreciate it. And I think it gives a good perspective on somebody that is just investing versus house hacking. So, appreciate everybody tuning in today, and hopefully, if you end up having questions, please feel free to reach out and be like Andrew. Go out and buy some real estate. Dip your toes in, and worst case scenario, you don't like it, and we'll turn around and sell them, and you can go buy some stocks or go on vacation or something like that.
If I can do it, you guys can do it.
That's right. So thanks so much for tuning in, and don't forget, go out, live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.